The 2008 crisis remains the closest example of how a shadow banking collapse unfolds. Shadow banking collapses do not follow the same script as traditional bank failures. The core vulnerability lies in how these institutions finance themselves. They use short-term borrowing to fund long-term or illiquid assets. This maturity mismatch means that when confidence erodes, investors and counterparties can demand their money back on short notice. Without access to deposit insurance or central bank emergency lending, shadow banks are forced to sell assets quickly, often in defaulting markets. The result is a fire sale dynamic, where selling begets more selling, driving asset prices down and triggering further margin calls across the system. Private repos and prime money market funds are especially exposed. They lack direct access to public liquidity backstops, which increases the risk of sudden runs. Large-scale redemptions or funding withdrawals in these segments can create systemic risk, as these entities are deeply intertwined with both financial markets and the broader economy. The 2008 crisis remains the closest example of how a shadow banking collapse unfolds. When Lehman Brothers failed, the repo collateral chains froze overnight. This paralyzed short-term funding markets and forced the Federal Reserve to introduce the primary dealer credit facility to provide emergency liquidity to primary dealers, an extraordinary step aimed at preventing a wider market breakdown. The freeze in repo markets and the resulting fire sales of assets quickly spread stress from shadow banks to traditional banks, demonstrating how tightly linked these sectors have become. The lack of direct oversight and formal support mechanisms means that a shadow banking collapse can move rapidly and unpredictably through the financial system.